How and when are Social Security benefits in retirement taxed? That is the subject of this video. Welcome to another episode of the Financial Fast Lane. My name is Lane Martinson, and if you're new to this channel, I am the author of the Holistic Retirement Planning Revolution. And on this channel, we discuss many of the topics in the book and many more. Specifically for people who are age 50 and over. And today we're talking about taxes on your Social Security benefits in retirement. So not to be confused with the payroll tax or the FICA tax while you're working and paying into this system. That is not what we're talking about. What we're talking about here today are when you're in retirement receiving your Social Security benefits, will those benefits be taxed, and how will they be taxed? So the answer is it depends on your other sources of income or assets. So if you take a look at my screen here, this is the provisional income formula. So provisional income is an IRS term, and what they're going to do is they're going to take any taxable income that you have. We refer to it as the taxable bucket, and I'll break that down for you. They're also going to take anything that you have coming out of your retirement accounts. We call that the tax deferred bucket. And then they're going to take 50% of your annual Social Security benefit. They add that all together, and that number is your provisional income number. And that is what determines if and or how much of your Social Security benefits will be taxed. So let me just break this down a little bit for you. The taxable bucket, it's going to include, it could be any type of investments that you might have. If you've got capital gains, taxes that are due, whether we're talking short-term or long-term, it's any realized gains. Any earned income that you might have. So if you still have a part-time job or any sources of income, if you have rental income, anything that's taxable is going to be coming out of this taxable bucket, right? Now, the tax deferred bucket, these are going to be your retirement accounts. So if you have a 401k, an IRA, maybe you have a 403b, 457, or a TSP, a thrift savings plan. While there are many different types of qualified retirement accounts, they all have one thing in common. Or a couple of things in common. That is, when you contributed into them, you did not pay tax on that money. Instead, you got a tax deduction, right? And so those contributions have been growing tax deferred. And so now when you get to retirement and you start to take distributions out, you will be taxed as ordinary income. And what is the tax rate going to be on that money? And the answer is, you don't know. Well, we know what it is this year, right? But we don't know what it'll be in the future because it's subject to change. And if tax rates are higher in the future, that means whatever you have in your tax deferred retirement accounts may not be what you actually get to spend in retirement, right? So it's a variable. You will have RMDs on this account, required minimum distributions, once you reach age 72. And so whether you want to take money out or not, you will be required to, so that they can collect tax on that money. In our provisional income formula, they're going to be taking any taxable earnings that you've got from the taxable bucket, any distributions coming out of your tax deferred retirement accounts, and then they take your annual Social Security benefit, 50% of that, and add that together. And that is the provisional income number. And so if you're single and your provisional income number exceeds $25,000, then that means that 50% of your Social Security benefits will be taxed as ordinary income at whatever the income tax brackets are at that time in the years in which you take distributions. If it exceeds $34,000, then 85% of your Social Security benefits will be taxed as ordinary income. So what that means is that 15% of your Social Security benefits will never be subject to tax, but most of it will be if you have done a good job or even an average job of saving in your retirement accounts. The thresholds for a married couple are $32,000 and $44,000 respectively. Now, I have the opportunity over many years to, with my clients in planning out their retirement income and different strategies that we put into place. And if you've done even an average job of saving in 401k plan or in IRAs, most people are going to find themselves easily in the position where 85% of their Social Security benefits will be taxed. And so this is what I refer to as a stealth tax, because a lot of people don't see this one coming. And so you might be looking at your Social Security benefits and you know this dollar amount that you're expecting or anticipating, only to find out that it's effectively reduced through taxation. And it can be a significant chunk, right? $5,000, $6,000, $7,000 or more per year lost to taxes. If tax rates go up in the future, it could be much more than that. Now, it is possible for most people to implement some strategies where they reposition their assets such that they're able to either completely avoid the Social Security tax or reduce their Social Security taxation significantly. But you've got to implement some strategies, and there is a window of time where you can get that done. At some point, we think in the not too distant future, that window of opportunity will be closing. But let me show you the end result. The end result is by simply implementing some strategies where your Social Security benefits avoid taxation, it will add about 7 years to a retirement portfolio, making your overall retirement income last 7 years longer. Now, everyone's situation is going to be unique and vary, but how do we do that? And we do it with some strategies, and we have to have the third bucket. So there is a third bucket. I like to call it the tax-free bucket. And so how do we get money into our tax-free bucket? It is, we're talking about Roth IRAs, Roth 401ks, Roth conversions, and some life insurance strategies. And that's it. That's the only way to get your money into a truly tax-free environment. And so when the money is in this tax-free bucket, regardless of what type of investments that you may have, all of the gains are tax-free forever. There are no required minimum distributions. And getting the right amount in each of these buckets is what will make a big difference. So this is a very important concept. There is a mathematically ideal balance to have in each of these buckets. Now, there are reasons why we want a certain amount of money in the taxable bucket. There's reasons why we want a certain amount of money in the tax-deferred bucket. But it's going to vary depending on your situation. So we have a standard deduction, and so there's a certain amount of money that we can get out of our tax-deferred buckets or out of our taxable buckets tax-free, because it's offset by standard deductions. But if we have too much, then it's going to kind of bump you up into a scenario where you're locked in and you're not going to be able to avoid the taxation on Social Security. And so we do this with strategies and relocating assets. We're talking about Roth conversions, a very important part of that. It could be other strategies that are implemented through the taxable bucket. Also, that can include real estate. There's some strategies. There's a number of unique ways to accomplish this. But if you have the right amount, you want ultimately most of your money in the tax-free bucket if possible. Now, everyone's not going to be able to make, depending on your situation, you're not going to be able to get all of it shifted into tax-free. But you can at least get a significant portion. But you've got to do, when you do Roth conversions, they've got to be done wisely, and you've got to use tax bracket management. And so we want to take advantage of the lower tax brackets, because if you convert too much too fast, it'll bump you up into the higher tax brackets, and you end up paying more tax, which defeats the whole purpose. So it's got to be done carefully. When it comes to retirement distribution planning and planning for your income in retirement, there are many different issues that you face that you never had to deal with prior to retirement. You have sequence risk, a whole new risk that comes into play, and I have other videos that address that and explain that. But Social Security claiming strategies and Social Security taxation, withdrawal rates, investment risk, inflation, all the different types of investment tools out there. There's a lot to consider, and a good plan is going to reduce risk without sacrificing gains and returns and growth, keeping up with or surpassing inflation, and losing money unnecessarily to taxes is something most people don't want to do. And so I have a website here where you can get a professional Social Security analysis if you would like. You just go to socialsecuritylane.com for more information on that. For a nominal fee, we create a professional Social Security analysis and report for you. I hope that you enjoyed this and found this beneficial. I look forward to seeing you in the next video.